Hi there, Chris Weston from the research team at Pepperstone. I want to go through the calendar this week and have a look at the setups that are on mind. Obviously, we're looking at the landmines and the risks that are playing through in the system, sort of teeing them up with the key thematics that are going through in the markets. And obviously, as traders, one of our core objectives is to manage risk and achieve correct position sizing relative to the volatility in the market and also your position sizing as well. So I think we can look at this from a sort of a multifaceted perspective, that being whether or not we're looking at opportunities to enter the market, what the flow looks like, what the setups are looking like, and then managing risk around the various events that are known to come out throughout the week. So I think what a good place to start is I've kind of put this loose calendar together. It's pretty raw. Apologies for that. But it gives you a good functional of how I've done this and thought about the week that will be. So I've just taken the marquee event risks. Obviously, there's other event risks that are playing through, and we sort of just got to marry this up with what the market's really interested in at the moment. There's obviously an obsession with interest rate hikes. How far can they go? When will that then cause a tipping point into growth? I think there's been big resilience in things like equities and credit, for example, because while rates have been going up and terminal rate expectations have been going up, growth has also been on the improve. And as long as growth's looking quite good, or looking, it's going to be below trend, obviously, but it's certainly well away from recessionary environments at the moment. I think the market is quite tolerant of higher interest rates until growth becomes a problem. And then I think, we could see higher volatility playing through in the market. So growth is the dominant thematic over rates. But what we're watching there is what happens throughout the week. So while we have seen in China the NPC meeting coming out over the weekend, they're targeting 5%. I don't necessarily think this is too much of a game changer. Remember, this target was probably set back in December before they knew a lot about how the reopening was going to be going. We can go back to previous episodes where they've set growth targets, and they typically become the floor, and then they stimulate and other factors. And generally speaking, you do see above consensus. So we're still pretty happy with a 5.5% growth target for China, even though they're targeting 5%, which the market seems to have taken as somewhat disappointing today. Now, in terms of what else we got, tomorrow we've got the trade balance numbers out of China. The market's expecting exports to fall 9%, imports to be down 5.5%. Impossible to forecast. It's generally, for analysts, this is one where they sort of pluck numbers out the air, and the market really sort of fails to kind of see any kind of volatility on the back of this because it is so hard to forecast. But I think it's the trend in the data. We really want to see domestic demand pick up a little bit in China because of the reopening story, and so we want to see imports move into positive territory. As I say, the market's there expecting a decline. So I think if we were to see a big pickup in imports, a growth in imports, that would be positive. We go to the RBA meeting on Tuesday tomorrow at 2:30 Eastern Daylight Time. The market has pretty much done a good job of discounting 25 basis points. Every economist is also calling for that as well. We've got a peak rate of 4.19%. On the 8th at 2 o'clock Eastern Time in the morning, or 3 p.m. GMT, Jerome Powell will be stepping up to testify in front of the Senate Banking Committee. He's data dependent. The Fed are pretty much data dependent. So I think he's going to be saying this obviously before non-farm payrolls on Friday. And then obviously next week we got the CPI print as well. So I'm not sure how impactful his comments will be. Obviously the market is really obsessed with, can we get 50 basis points on the 22nd of March? We're pricing about 31 basis points, 32 basis points there. The JOLTS report, the job openings report's coming out on the 9th at 2 a.m. again, pretty similar, just the 24 hours after Powell speaks. So 2022 for me was a job opening story, and the market is expecting job openings to fall to 10.58 million. Bank of Canada meeting, I'm not expecting that to be a vol event. They've told us that they're going to be on an extended pause for a period of time. We're not pricing anything for this meeting coming up, and then 26 basis points being priced out to the terminal pricing in September. So I don't expect that to be a vol event. I've put the Mexican peso in there, or the Mexican CPI numbers in there, because the Mexican peso is by far and away the strongest currency this year in major currencies, in fact global currency markets, because of its leverage to a growing share of US imports. The Tesla news recently, where they're going to be building gigawatt factories in Tesla factories in Mexico, obviously helping there as well. And also you got one of the biggest carry regimes they're playing through. Bank of Japan, Kuroda's last meeting, not expecting that necessarily to be a game changer. Don't expect it to go out of a bang, but certainly something we will be focused on. And then the big one on Friday, which is the non-farm payrolls number, 12:30. Look, the market's looking for 215,000, unemployment rate to stay unchanged at 3.4%, and then wages at 0.3%. Look, I think this is part of the big two. This and CPI next week, if we were to get a big blowout number again that suggests last month's 517,000 was not an anomaly, then I think you could see that rates pricing moving up quite sharply. And I think the dollar will rally pretty sharply. So a poor number would, somewhere probably like less than 180, I think would probably be considered to be a fairly poor number and see a cooling of the labour market. And I think growth assets could rally quite nicely. Dollar yen could move quite nicely. So I think that's the big one. I think a blowout number, anything above 300,000. 280 is your one standard deviation. I think it's important to also tell you that in the last 12 non-farm payrolls, 11 of them have beaten consensus there. And if you look at the top 5 rated analysts by their form, they're calling for an average of about 250,000. So the risks one suspects are above on the establishment survey, but calling that is very difficult. It's a bit of a lottery. So let's go through the charts. I think this is an interesting chart. I've seen a lot of people recently talking about liquidity in the US, and you can basically use a real simple liquidity model, which I've used, which is the blue line. And really, what I've used on TradingView is the Fed's balance sheet, and then subtracted in parentheses RRP against the Treasury General account. So really, we're looking at the Fed's balance sheet relative to some of the other liquidity measures. If this is moving higher, it's basically telling us that net liquidity is coming into the system. And if it's falling, then liquidity is moving further out of the market. Now, what you can typically see over time is that there has been a reasonably good correlation between net liquidity from the Fed's balance sheet and other Fed's operations and the S&P. That has broken down now. Now, the question is that going to mean revert? We've got this against the S&P, which I put as a line in the orange number there. And this has been getting quite a bit of attention because some people are saying that net liquidity suggests that the S&P should be rolling over. But of course, that hasn't been the case. Actually, we saw a little bit of a pop last week in net liquidity, and I think that's good for part of the reason you can explain some of the short covering coming in the S&P. But I think this is an interesting one here. You can see the code there for anyone who wants to copy this. This is one that I think Morgan Stanley originated, where we're looking at the total balance sheet of the Fed minus RRP plus the Treasury General's account, which is the checking account with the Fed effectively. So if that's going down, it shows cash potentially getting into the system. If it's going up, then cash has been withdrawn from the system. So you can see that right now the equity market is trading expensive relative to net liquidity, although that is some considered to be an overly simplistic model. Anyway, one to concern yourself or consider. I'm going to go through some of the other charts now. So what we've got is interest rate markets. We can see here, this is what's priced for the next meeting. We've got 31 basis points of hikes. Again, this is a model that you can copy. You just use this code here, and you'll be able to work that one out. We can go out to the peak rates in Fed funds. This is one that I've put together. Again, you can just see the model that we've used here. We've used the September Fed funds, which is this code here. We've subtracted against 100, which is the effectively par. And I've used September because I've on my rates market that you can effectively copy from. Where are we looking here? You can see all the different rates markets, but you can see this is effectively the highest point in the rates market that I've got coming through. And again, just charting this through, you can see that last week there was a big move up, big shift in terminal rates pricing. The question now, will this break through 550? I think that's going to be down to what we're going to be seeing in JOLTS reports and obviously what comes down onto non-farm payrolls number. If we were to see that breaking through 550, I think that's going to be very good for the US dollar. I think that could be a bit of a tipping point for risk. But as I say, at the moment, despite what we've been seeing in Europe and the UK and certainly here in the US, rates repricing coming through, it hasn't necessarily caused too much angst coming through in financial markets at the moment because growth is holding up. If rates were going up at a time when growth was falling, that's when I think you're going to be seeing equity markets and coming under pressure, the US dollar really rallying quite sharply. One of the big talking points here is what's happening in short-term government bonds. I think this is the new situation which has been causing a lot of angst in markets, is the idea that you've got choice now. If you're an international money manager, you can go and get 6-month paper and lend to the government effectively and get a 5.16% risk-free yield effectively. I know some people are focused on the debt ceiling, but eventually you will be made right even if there's problems. But for now, you are seeing high yields playing through. And of course, for people who are looking at the equity market, you've got to get at least a 5.16% return before you're beating the risk-free rate. So effectively, that's something that's come up on people's radar. And again, that may be weighing to an extent on the equity market performance. We didn't see that last week, as I say, but there's definitely something that people are saying could be a bit more of a challenge going forward. We talked about what's happening in the terminal price, but we can see that also through 2-year Treasury yields. I think the eyes of the market is whether we can get above 5%. We did see that sort of pushing up into 4.96, and a few buyers took yields down on Friday. Something we are watching as we go through that series of data. I think also if you're looking at the 10-year Treasury, we did sort of see that moving up to just above 4, nearly 4.09. People use this as the discount rate on equity markets, to look at the future cash flows and look at the net present value. And as that discount rate's moving higher, the net present value of these assets is falling. Some people will use shorter term rates. You could probably now use the 6-month Treasury as effectively as your discount rate. Some people will use real rates as well. But that's one factor, is when we did see buying coming through and yields falling, the equity market rallied quite strongly. Now, how does this mean for the dollar? We've seen sensitivity to what's happening in interest rates very much there. If yields continue to move higher again, based on the better data we're going to be potentially seeing, then you're going to see the US dollar fly. And as you can see, we've moved up into this zone 104.92. Traders are happy to lean into there at the moment. I think the bulls are getting a little bit frustrated. We want to see a break of there. You could take this into the slightly lower time frames. You can see this kind of consolidation playing through, this kind of sort of pennant pattern playing through. But clearly, the line of the sand in the dollar is 104.92. The bulls want to see a break of that, and then we'll be looking for momentum longs to take that potentially into 106. We've got our eyes on these lows coming through around 103.73. I think if you look for a pullback into those kind of levels, that may be well supported. From a momentum perspective, I think if we get a closing break of that one, that may dictate my bias to start looking at short positions more openly in the dollar. But we're consolidating at the moment, and I think we need to see high yields playing through. Dollar yen's an interesting one. We've broken up into the 38.2% Fibo of this decline you've been seeing here. I think for the sort of moving average hedge, you can see the 200-day moving average there. So you've got this kind of cluster or this confluence of resistance levels here at the moment. Clients from Pepperstone are sort of progressively net short on this one at the moment. But again, this is going to be very sensitive to what happens in terminal rates pricing, what happens in 2-year treasuries. And if that data in the US continues to be better, and that payrolls number on Friday, is better than expected, and certainly if it was to come out over 300,000, then we could be looking at 138 and above. That RBA meeting, so how's the Aussie looking? Yeah, we're just consolidating going into that. Obviously, that's a reflection of what's happening in the dollar more than anything else. But you can see there's good support coming into this 67 level. Long wicks on the tails that are coming through on the candles, and you can see good support, really from around 67.24 down into the figure. So that the Aussie bears would really want to see that just being nibbled away. And as you can see, just a daily close below the kind of figure. And that opens up to really what's going to be the head and shoulders down target down into 65. I think if we were to see that net liquidity issue really catch up and the S&P rollover, then I think you're going to be seeing the Aussie coming under pressure and high beta currencies coming down. One thing, if we go into equity markets, I want to just quickly look at what's happening in European equity markets at the moment, because we've seen new cycle highs playing through in the Spanish market, the SPA 35 and Euro stocks, and also the DAX. The French CAC is about to do something similar as well. Now, I think part of this can be explained by hedging costs in the US. If you're a fund manager and an international money manager and you're looking at international investments, you can go and have a look at that 6-month Treasury bill and say, you can reflect that into currency hedging costs. And that to hedge an international portfolio of US stocks, it's going to cost you a lot of money relative to what you're getting in Europe at the moment. So those hedging costs are seeing people sort of look at international opportunities. I think, whether it's a currency play or not, you are seeing internet valuations making a difference, and the money is being reallocated out of the US and into Europe, which is clearly outperforming at the moment. And you're seeing those cycle highs breaking out. So that's the momentum trade in Europe. We'll have to see if that can continue supporting euro dollar. If you have a look at what's going in US dollar, S&P 500, this 200-day moving average clearly being supportive, and you can see buyers stepping in there. That needs to go, and then you get this form of downtrend coming into place. As I say, that net liquidity issue is very much there. Gold's a really interesting one as well. It's sort of broken away with what we've been seeing in real rates and terminal pricing and various factors such as that. It had been a nice momentum juggernaut. We'd seen the bullish outside day reversal, which had started the trend. We saw buyers breaking through the previous high. We saw buy stop orders going off through there. The level which I think a few people are looking at is 1862. That's the 38% Fibo of that sell-off. But you've also got this big liquidation low that comes in around 1862 as well. So I think that's kind of the line in the sand. You might see a few scalpers looking to scalp off that level. But I think a break, and then you're talking 1880 and into maybe even into 1900. Given the fairly low realized and implied volatility in gold, it's going to be more of a grind, more than sort of this impulsive move up. But I think that's an interesting one. You can also then take that currency into yen terms. That's an interesting one, because if you look at the range that we've been seeing in gold in yen terms, obviously with Bank of Japan very much in play, you've got this series of resistance levels into 252,000 yen. And again, we're coming into the top end of what is massive resistance levels there as well. So one, for the scalpers who won't want to just take this into these levels and just look to fade that move there as well. But we're coming to massive levels that are playing through. On crude, top end of the range once again, a bit more of a pushback into this swing high that we saw on the 13th of February, 80.54. But the big level, of course, everyone, if we can get a bit of a squeeze on, if we can get a good non-farm payrolls number, which I think crude would benefit from, despite what happens with the US dollar, is then you get 82.30, which is the top end of that trading range, which we bounced off many, many times. Of course, the volatility that we saw on Friday was very, very pronounced indeed. So a big level there to look at. And then we come into Bitcoin. I think obviously consolidation, 4 candles of really doing very little on the daily chart there. The big level everyone's watching, of course, 21,645. Big non-farm payrolls, big jobs report, some of that liquidity coming out of the market. I think the dollar rallies, and I think you probably get Bitcoin coming down into that number where it could get interesting. Of course, as traders, it's not about giving you levels, it's about how markets act at those levels, and that's what gives us the insight which we react to as traders as well. So a big week ahead, obviously very much focused on what's happening with the RBA. Will they really tell us that the terminal pricing, or give us indications that terminal pricing is on the money or too rich? I think that's where we can see some volatility in the Aussie dollar. But really, for me, it's about the non-farm payrolls number, and also Jerome Powell to a lesser extent. But that non-farm payrolls number ahead of next week's US CPI number could really give us some insight whether 25 basis points is a done deal, which it seems to be the case at the moment, or whether 50 basis points could come onto its own at that 22nd of March meeting. And I think we see high volatility. So one to watch. Any questions, do reach out to the team at Pepperstone. Have a good trading week.